What's the minimum holding period for equity-based mutual funds you would say to your investors?
Yes, 10% arbitrage for safe side, 90% equities, out of which about I would say 20% US, 80% India, combination of liquid as well as illiquid. Let me put a disclaimer that people should not follow
No, of
my
course
pattern.
not.
It's just been an outcome, but mids and smalls will be more like 80%.
And last 5 years, money flown into mutual fund has tripled. 10 years, sixfold. Do you see that the valuations right now for mid cap and small caps are not justified? Akhilji, thank you so much for your time today. I was reading this data that I had where, as per Economic Times in 22-23, slightly older data, but 50% investors redeemed their mutual funds within a year.
Wow.
And I just wanted to get your perspective, and I got the reaction already. What's the minimum holding period for equity-based mutual funds you would say to your investors?
See, ideally, one should not really restrict themselves into a minimum holding period,
Sure.
like a 3-year or a 5-year or 10-year. There is no minimum waiting period.
Right.
You should be lucky and you should hope to, Almighty, that your capital is invested permanently.
Right.
Because, like again we discussed, the more number of years your capital is invested, those many years of compounding and that much compounding of wealth you are doing over long term. To put very simply, as quoted by Warren Buffett, he puts it very nicely that invest when you have money and redeem when you need money. So
Right.
unless you need money for any emergency, medical, or your goal has reached, you want to buy a home, for that you want to pull out, that's okay. Or maybe it's your retirement or something like that. Unless you don't need the money, allow it to compound. Now, what you are referring to is that a large number of investors have withdrawn money within 12 months.
Right.
Why this happens is, it's a typical human behavior. We tend to react basis our recent performances. So there is a recency bias which
Right.
comes into play. If your recent experience in your investments is not positive, it is not attractive, it does not give you the kick, and there is a lot of let's say pessimism generally in the economy and the markets, people get worried.
Right.
That, oh my God, have I done something wrong? Am I in the wrong asset class? Did I come at the wrong time? And we tend to extrapolate what has happened in the previous 12 months into the next 12 months.
Right.
Right. So when you extrapolate, you feel that not only have I not made money, I will not make more money, much rather I may lose more.
Right.
So people start to do cut loss
Yeah.
or stop loss. But that was never the intention to start.
Right.
The
Of
intention
course.
to start was invest for long term and create wealth.
Right.
But after investment, because these are all open-ended products, you have NAVs coming out every day, prices are there for you to see. When you see volatility, when you see drawdowns, losses, you tend to react. Now, last year for India has not been a great year. Indian equities have underperformed global equities. They have underperformed US by a huge margin, China by a huge margin. And on the other side, gold and silver have given like rocket returns, right? So there is a FOMO that, here, in gold and silver, people are making money, and out here, we are losing money. So I think a lot of this money probably has got rebalanced into
Right.
probably gold and silver, or probably gone back into cash, and hopefully someday will come back. But I think it's the biggest behavior mistake one can make is that within 12 months or within 24 months or within 36 months, you react basis recent performance and completely ignoring why you had invested, for what purpose you had invested. And that is where we stop the journey of compounding. Right, and then you have to restart from zero again.
Right.
Right.
So basically what you're saying is, if your mutual fund portfolio is down mainly because markets are down, you're not getting good returns because markets are down, which is the case right now.
Yeah.
That shouldn't bother you.
No.
That shouldn't really impact your withdrawal or the redemption.
Yes.
Rather, that should be either goal-based, if your goal has been met, or whether you need the money, then you go and withdraw the money
Yeah,
if you need to.
if there is a reason to withdraw, you withdraw. Do
Right.
not withdraw, or I would say do not invest just because markets are doing good.
Yeah.
Just because returns are good.
Okay.
Right? You are not investing to make returns. Let me put it this way. You are investing to meet a larger goal, a larger purpose in your life. For that, you have to give that much time to reach that goal, that outcome, what you desired for.
I think one very linked question I have for you is, one is, okay, let's ignore the market cycles, let's ignore the noise. But what if I have a mutual fund in my portfolio and it's been underperforming the index?
Yeah.
Now that happens.
Yes.
There are a lot of active mutual funds where it's not even beating the index.
Right.
How long do I continue to hold it? Because this is a question that keeps coming in my mind. You see your mutual fund portfolio last 4 quarters. This mutual fund is underperforming the index. Is it time to sell it off or not?
Yeah.
What's your take in such circumstances?
So I'll tell you that markets go through cycles, right? Markets are not giving you returns consistently year on year. So over the last 10 years or 15 or 20 years, you would see that there are a few years markets have given great returns and a few years markets have not given you great returns, right? That doesn't mean you don't invest in markets.
Sure.
Similarly, when you buy into mutual funds, mutual fund managers are also trying to invest in the same market and trying to outperform the market over a long-term period. That doesn't mean that they will consistently outperform the market every year, every quarter, every month, or every 3 years also for that matter, right? Over a long-term cycle, let's say 10-year cycle, there could be a couple of years where a fund manager, maybe because of his style, maybe because of the philosophy, maybe because of, in general, the portfolio also goes through mean reversion. If the fund has done very well, for some reason, there could be a couple of years where a fund manager can also underperform. But there'll be several years where he will also outperform and outperform very, very smartly, right? So over a 10-year cycle, typically what I've seen is over a 10-year cycle, generally mutual fund managers would outperform the broader markets, right? My suggestion is that in short term, these questions will come to you. In short term, you will see that you have trusted a fund manager and the fund manager has underperformed, and you may be tempted to take some action. Before taking the action, I would say that first be very, very sure where you are investing, right? You want to take help, you take help. You want to go online, you want to do all the research that which is the asset management, what is the philosophy, what is the process, how is the portfolio looking, how does the portfolio churn from time to time, what is the long-term track record. So there are several parameters you can put. It's like, before buying, do all your research. Once you have bought, then give that manager a decent cycle. I would say at least give a 3-year or a 5-year cycle to do first level of check.
Right.
I'm not saying that after 3 years you sell out, but after 3 years of underperformance, consistent underperformance, again you can go back to data, again you can go back to the manager commentaries, and if you feel that the rational basis which you invested is not matching with what is actually coming out in the product, or you are not understanding what is happening and you're not getting the conviction, then you sell out. Otherwise, just be with that fund. If there is an underperformance, equally there will be outperformance. So you will go through multiple cycles of performance, underperformance, and over a 10-year, 15-year period, typically, even if there is a 2% outperformance over a long-term period, you will do far more better. So be very, very choosy before you invest. Be very, very cautious before you disinvest. Most of the times I've seen investors have withdrawn money and that was the bottom of the fund.
Right.
The moment you pull your money out, or the moment there is an exodus of money from a fund which has not done well for 2-3 years, the moment we see that redemption is spiking, subsequently in the next 12 months, we see that fund is getting into the top quartile ranking.
Right.
Right? So it's a serious subject. There is no right or wrong answer for this. But yes, if you are investing on your own, do a lot of research. Otherwise, take help, and there is a lot of help available.
I think the reason I was trying to get into the details of this particular question was mainly because if I'm giving 3 years or 5 years of my time, that's a precious time that I'm giving to somebody.
Yes.
And if they continue to underperform, there is definitely a question that I ask myself,
Of course.
okay, maybe I made a wrong decision in
Of
picking
course.
a mutual fund. Therefore, I don't need to continue because a mistake has been committed, doesn't mean we continue with it. So, but you're saying that more or less 3 years to 5 years is the time you need to give them.
At least give the first 3 years.
Okay.
Then if you're liking what you're seeing, you're liking the portfolio, you like what the manager is talking, give it 2 more years. So you take it step by step.
Right.
The day you lose complete hope, then obviously you do your rebalancing.
Yeah, of course. Now let's just talk about rebalancing. So rebalancing the mutual fund portfolios, this is a topic out there. I don't think there is a lot of good content coming from experts like yours. So I really want to nail it down as a topic. So let's spend a few minutes on it. So what is rebalancing? Let's start from basics first. And then how frequently do you do it? What sort of considerations you make while you're rebalancing your portfolio? If you just can summarize this, that will be really good for us, please.
Yeah, so see, rebalancing in financial assets basically means that you are trying to change the asset allocation pattern of your portfolio, or you're trying to change the underlying constituents of your portfolio from time to time.
Okay.
Now, typically what will happen is that on a occasional basis, the first level of rebalancing happens is when you have decided a certain asset allocation pattern. Let's say, hypothetically, we have decided an asset allocation of 50% equities, 50% cash.
Okay.
If that is the basic allocation we have decided, and today we invest accordingly. After 1 year, for some reason, equity markets go up 10%. So your 50% goes to 60% and your cash goes to 40%. So if you're doing an annual rebalancing of your overall broader asset allocation, then after 12 months, what you can do is you can book profits that extra 10% back to 50 and increase cash to, so make it 50-50 again.
Right.
Now what happens in doing this is automatically you have booked your profit to the extent of the gains which have got accrued in your equity portfolio. In a other scenario, if after 12 months, equities has gone down for some reason by 10%, so your 50 has become 40, then you take from cash and you add to
portfolio
equity. So now what you have done is you have bought at low and you have rebalanced your portfolio.
Right.
If you can do this consistently, maybe every quarter, it could be every 6 months, it could be every 1 year, I would suggest 12 months is a good period to look at the overall asset allocation mix and then rebalance your portfolio. Right, so that is one level of rebalancing. Second level of rebalancing is more tactical. It's like when, let's just look at equity portfolio for the time being. Now in equity, let's say you have put some money in large cap, some in mid, some in small. Now for, let's say, last 3 years, mid caps and small caps have done very well. They are looking very, very expensive. And it's reflecting in your portfolio. The returns are looking outlier. Then you can also decide that in your equity portfolio, how much should be your large cap, how much mid, how much small. Now, if there is imbalance in the exposures towards different market cap buckets, you can again rebalance it and bring it back to the original design what you had thought while creating a model portfolio. So that's the second level of rebalancing you can do. Third level of rebalancing could be that from time to time, there could be new asset classes which are coming up,
right.
New ideas, new opportunities. For example, honestly, for last several decades, we have really not looked at gold or silver as a financial asset. We have also always looked at gold and silver as a physical asset, more in terms of ornaments which our wives and sisters and mothers are actually consuming. Nobody really has a gold ETF. Now, of course, they're getting popular.
Yeah.
But given the current context, the current geopolitical situation, these commodities are looking good and it's easily accessible. So then you have to rebalance your portfolio. You want to add a new asset class. Again, you decide an allocation, you rebalance your portfolio and then you follow it, right? So I explained to you what rebalancing generally means. Within that tactical allocation within equities, within fixed income also you can do rebalancing of your portfolio between short-term portfolios versus long-term portfolios. Let's say you feel that, and actually it's happening in India where we feel that lower inflation will lead to lowering of interest rates. Will have an inverse relationship in the bond prices. If the interest rate comes down, the bond prices will go up. So there is a case that in the next 12 months, even bonds could give you good returns. You may actually change your debt portfolio into medium-term funds or long-term funds or gilt funds and try to take advantage of higher yield even on your fixed income portfolio. Right. So these are some ways, basis which you can rebalance your portfolio on an ongoing basis, depending on your set pattern.
So for a rebalance portfolio to happen, you have to have a starting point for the asset allocation. You say that, okay, 40% is, let's say I'm going equity, 30% I'm going in precious metals, 10% going into US market. And then or remaining is debt, for example, or cash or whatever, and then you maintain this, let's say on 12-month basis.
Absolutely.
Now, this asset allocation, I just wanted to ask you personally, how's been your portfolio shaping up? Like, what sort of asset allocation you have followed personally? That I would like to know.
So I've been a very aggressive investor.
Right.
I come from a middle class family, so I had a lot of aspirations. I had a lot of dreams, and I really wanted to become very, very wealthy. So from the time I started to work, I've been largely tilted more towards equities. Within equities, I've experimented all kinds of things. Some things worked, some did not work. But I can tell you that in the last 20 years, I've been disciplined investor into equity mutual funds. Largely through the SIP way. What I've done broadly in my portfolio is I have kept 10% into arbitrage,
Right.
which is my cash position.
Okay.
Right? It's not very risky. It's not volatile. It gives me tax advantage. I can get the money whenever I want. I use this money if there is any big opportunity to invest or if any emergency. Hopefully, it never comes. So 10% is a static exposure towards arbitrage category. My 90% is all equities, but over the last 4 or 5 years, within this equities, about 40% has gone into private equity,
Right.
some unlisted ideations. So it's a combination of listed and unlisted portfolio. I've also recently taken some exposure in US, in the basic US funds like a Nasdaq, S&P, but also some private ideas out there. So,
Right.
but largely it's an equity portfolio.
Okay. Okay,
In India,
90%.
arbitrage is also equity. So you can
Yes.
say 100% is equities. But yes, 10% arbitrage for safe side, 90% equities, out of which about, I would say, 20% US, 80% India, combination of liquid as well as illiquid.
And within equity, how much is large cap, mid cap, small cap for you?
Zero large cap.
Zero large cap, okay.
Absolute zero large cap. It's all filled with mids and smalls.
Mid and small. So
I've got some thematic ideas also.
Right.
I've got some factors like momentum,
Okay.
active momentum.
Right.
But large part of the portfolio is mid cap and small cap.
Okay. So you are riding on mid cap and small caps.
Yeah.
And put together mid cap, small cap, what sort of allocation you would have had? 50%? 40%?
Yeah, let me put a disclaimer that people should not follow
No, of
my
course
pattern.
not.
It's just been an outcome, but mids and smalls will be more like 80%.
80%. Right. Okay. That is very high allocation. Okay.
20% would be flexi cap, multi cap.
Right. Okay. Okay. I was reading this data as well from MFI, and I'll put that up as a chart. And last 5 years, money flown into mutual fund has tripled.
Yes.
10 years, 6 folds.
Yeah.
Now, given this massive money flow into mutual funds, especially in mid cap and small cap, do you see that the valuations right now for mid cap and small caps are not justified? Because there's such a massive rally post-COVID we have seen, and there is a fear. At least I sometimes feel like if I put more money in mutual funds, especially the mid cap and small cap, can they continue to give me this run up now? Because there's already a huge run up that they have given. So what's your view in terms of valuations for mid cap and small cap?
See, the valuations, it's a little bit of a longish answer, but what you've seen in India over the last 5 years is that between 21 and 24, in 21, India was looking very attractive. Valuations were rock bottom. Economy was gearing up very well after the COVID. We have been the fastest growing economy. We managed our inflation better. We managed our interest rates better. And the economic growth has resulted into very strong corporate earnings growth. Literally, Nifty 50, top 50 companies, EPS has actually doubled in the last 4 or 5 odd years, right? Mid caps have tripled and small caps have quadrupled. That is what has resulted into the strong rally we have seen between 2021 to 2024. And it's been like mammoth rally, right?
Yeah.
Obviously, with that kind of a rally and that kind of a base, last year has been a little soft year. Valuations were looking very expensive early 2024 for our mid caps and small caps both. The drag in performance over the 12 months has narrowed down the valuations. The premiums of mid cap over large cap is still there, I think about 50% or so. But small caps have really contracted, right?
Okay.
To a large extent, there is a time correction which is happening. And the other thing is that the corporate earnings growth in the last 12 months also has been a little bit of on a softer note. right? So because of the higher base. So now today, as we see, certainly valuations are not like,
Where they
to
were
die
1 year.
for, like
Yeah.
you jump tomorrow. Markets are consolidating. Markets are time correcting. We feel that the earnings growth cycle is picking up once again. The second quarter numbers have been better than the first quarter and the last 12 months. As the earnings growth will pick up, valuations will start to look better. Anyways, there'll be new ideas. So I think going forward basis, try and stagger off your mid cap, small cap exposure. Maybe in the next 6 months, 9 months, 12 months, whatever allocation you want to build, try and stagger it. It's not very expensive. It's not very, very cheap. You're somewhere in between, but
Right.
far better than where we were 12 months back.
And let's say in the next 2 to 3 years, mid cap and small cap, there are pockets where still there is a good valuation.
Yes.
What are those themes? What are the things that you're looking at right now?
See, some of the themes we are really excited about has been one very large theme, which has been manufacturing, right? There's a huge push. See, the government is doing a lot of push to ensure that manufacturing comes back in India. So when they say that, make life easy for businessmen, clear all the regulatory hurdles, government themselves are putting a lot of money in building infrastructure. See, today our manufacturing to GDP is about 12-13%.
Right.
China's at 30%. Some of the other strong emerging markets are more like 22-25%. India has to reach there. If we have to grow at 8%, we need to get manufacturing act together. Government has also cut corporate taxes such that there is more cash flow for the promoters to actually do capex, etc. So this manufacturing, which is a large play, largely sub theme, you can divide into China plus one. And make in India. I think this is a very big opportunity in the next 10 years.
Right.
Very, very big opportunity. And it's a very vast space, because if you take the top 500 companies on Nifty 500, 65% is manufacturing. It could be consumer durables, it could be power, it could be pharmaceutical, it could be wires, cables, anything, cement, steel, everything is manufacturing. So it's a very diverse space. So this is one large theme. And if you see our portfolios, you will find 25-30% exposure towards manufacturing. The other big play, what we are seeing is really the capital market businesses. Now, again, as the markets have done well over the last 5 years, brokerage firms, asset management companies, we are looking at all the capital market intermediaries, stock exchanges, all of their businesses have multiplied big time.
Right.
Because more and more participants are coming into capital markets. You are having doubling of investors in mutual funds. You've seen almost 10-fold increase in the DP account holders, right? So all these investors coming are some way or the other giving profitability to
Capital market
exchanges,
companies, yeah.
mutual funds, wealth management companies, brokerage firms, and therefore you can see how the profits have been compounding over the last couple of years. And this force is going to continue. We are still penetrated by only 5%. 5% of India is investing into capital markets, right? So I feel this is going to be a very, very long-term theme. You can also include insurances in this now, because under-insured market, with the GST rates coming down for life and health, I feel that the premiums will come down and more people will take insurance. So insurance also can be a very good, very long-term theme. So this is all about the BFSI space, right? So banking is there, it will always be there. So that's a static, but high growth, I would say, capital markets, right? The other thing which is, for your people like you and young investors, is the digital theme, the new age consumer companies, right? So in US, you have your NASDAQ, and then you have all your FANG companies. In India, we are having our own, FANG equivalent companies like I can't names, but you have several listed opportunities now in the food tech space or the fintech space or the pharma tech space, travel, tourism. All of these businesses are getting disrupted by platforms coming inside and giving you whole bunch of services right at the doorstep, right? So digital businesses over long term, I feel is going to be extremely, extremely exciting, right? So digital is another big opportunity. I would say that maybe healthcare. That's another. So not the the old traditional pharmaceutical businesses, But hospitals, diagnostic companies, pharmaceutical also, there'll be some niche pharmaceutical companies which will come up with differentiated products. So this is also another space. So these are broad 4 or 5 big themes where growth should be very, very tailwinded for India.
Right. I think just want to go back to new age tech companies. Some of these companies, again, of course, we don't want to name them here, but a lot of these companies are actually making losses.
Yes.
We all know the names of
Yes.
those companies,
Yes.
right?
Yeah.
So, when we are in a world where these companies continue to make losses, they continue to raise funds, how long can it survive, right? How long can it sustain? So that's my question. And within the new age tech companies, then are you looking at specific pockets, or are you looking at this as a broader theme?
So we are looking at a broader theme. We are evaluating all kind of opportunities within the digital space. We have, in the past, we have invested into the compliance space, a company which gives compliance services
Right.
through the technology, or some food tech businesses, or some fintech businesses. Now, you're very right. These businesses are all about 10, 12 years old, right? And over the last 10, 12 years, they have grown their businesses. Barriers to entry is very, very high for any new entrant to come into these businesses and then become as large as some of the existing players. And as these companies are now maturing, they are also now thinking of path to profitability, because the moment you list your companies, then the shareholders quarterly results will start,
you
and
will have
then
to have the earning
you have to focus on
Yeah.
the growth. So for now, if you see, different businesses have different business models and different profit matrices and different periods where they are targeting large pools of profit to accumulate. I think these businesses will take at least next 5 years to really make meaningful profits, as these companies are actually trying to grow. So they invest a lot of money back into marketing, acquiring customers. Cost of customers acquiring through digital ways is very, very expensive. So on an operating basis, a lot of companies might be making decent cash flows, but because they are reinvesting the cash flows, the profit after tax looks very, very small. Right. So these businesses cannot be seen from the conventional lens.
Okay.
These businesses have to be looked at more from the moat, barriers to entry, limitations, number of customer acquisitions, generally what is the path to profitability, margins. All of those things have to be, and that is what we are trying to do when we are evaluating these businesses, or we are when we are investing, we are giving them 3-year, 5-year
Right.
kind of a window, and we have to monitor these very, very carefully. You have to be very, very careful out here to monitor them and ensure that you are not sitting on any time bomb.
Right.
Yeah.
Akhilji, I want to come back to now mutual funds, right?
Yeah.
So, last 1 year, Indian stock market, not much returns, not much cheer, not much smile for our
Yes.
mutual fund investors. What's the view for the next 2 to 3 years? Let's not even go to 2030,
Yeah.
because I don't know, a lot of people are expecting some sort of relief coming from stock market, so that at least there is some cheer.
Yeah.
Right? At least 10%, 15%, 20% of portfolio uplift is what we see. So when do you think it's going to be there?
It's a very good question, and I hope I can answer. But I can certainly tell you that after this brief 12 months of cool down in the Indian markets, and let us keep in mind that our markets have not corrected.
Mm-hmm.
I mean, it's just not given return.
Right.
So we have not been through a 20-30% crash and that we need to be worried about what's happened and all that stuff. But I feel that the next 2 years look far more better, positive. The probability of getting decent returns is much higher than what we expected a year back.
Right.
Why I say this is because India's macro setup continues to look very, very strong compared to any global markets, right? The world grows at 2%. I think the second quarter GDP number also will come at 7.2%.
Mm-hmm.
First quarter, we have seen 7.8. Mm-hmm. So we are a fast-growing economy. Basis the reforms done by the government in the last 12 months, they have given tax breaks, so up to 12 lakh rupees, no tax. Interest rates have come down, so the cost of capital is down. We have seen GST reforms recently. So the government is trying to push for growth, one by doing investments, by creating infra, and secondly, getting consumers to buy more.
Right.
Both the engines will fire and the economy hopefully should do better than what it is doing today. Combined with almost close to zero inflation. Even if we take 2-3% long-term inflation, I think broadly good. Expecting 2-3 round of rate cuts. Very, very positive for the macro to play out, right? As I told you sometime back that the earnings growth bottoming out has also happened.
Yeah.
So from here, if the earnings growth starts to pick up, we expect Q3 numbers to be better than Q2.
Right.
On the whole year basis, FY26 numbers will be better than the FY25 numbers.
Right.
As per Bloomberg, FY27 is looking very healthy. So earnings growth, which is the micro side, macro is good. Liquidity continues to be fine. So you are seeing while FIIs have been selling us, but adjusted for FII outflows, still our markets are getting net positive inflows thanks to the domestic liquidity which is coming up. So good macros, good micros, strong liquidity gives me that much confidence that the future is better than what we have seen in the past. And then in 12 months, if other markets like US and China have done very well, maybe they will cool off, and maybe because
Money
the
will
winners
flow
rotate.
back. Yeah.
You would have heard this concept that winners will always rotate.
Right.
So whatever is done well today will go through a mean reversion next year, and then something else will come up. So from that mean reversion perspective, I think India is due for what we deserve.
I hope so, because it's been, as you rightly said, so many good things have happened.
Yes.
But such is the stock market that it's not moved much. So hope that 2026 and 2027 are better
First
years.
time where we are seeing that the government is actually taking proactive measures to reform to ensure that we are insulated from the global shocks.
Yeah.
Right, and that we can be self-reliant, we can produce our own goods, and we can consume our own goods, and we are in a very good space, honestly, right now. Returns will come. If at all you're doing good, returns will follow.
Definitely.
Till such time returns are not coming is the window where you can come inside.
Right.
And build your portfolio.
Yeah, I think that's very wise. Thank you for that. We're just going to move to the rapid fire now. Few questions I'll ask you.
Sure.
And let's see what your choices are. Indian IPO market right now, would you avoid or invest? Because there's a lot of controversies around valuations, a lot of chatter around profitability and whatnot. So where do you stand when it comes to Indian IPO market at the minute?
So I'm not a great fan of IPOs.
Right.
So I don't invest in IPOs. I would say it has to be very company specific. Some IPOs can be good, some IPOs can be expensive. So be mindful of what you're doing. Don't follow the bandwagon. So be selective, I would say.
Yeah. Mid caps or small caps as of now? Which one would you pick?
I would stay a combination of both mid caps and small caps. But if you tell me one choice, I will go with mids.
Mid caps, okay. What's the one secret of generating long-term wealth in your view?
Long term.
Need
to be long term.
One golden rule of investing that you want to share with us?
Don't try to time the market. Time in the market is more important than timing the market. Right. Maximum mistakes happen in timing the market. Markets have gone down, should I invest? Markets have gone up, should I exit? How much more the markets will go down? How much more the market? So if you're going to be in this kind of a game, you will never make money.
Right.
So just invest and just we had this whole tagline: buy right, sit tight, right? So just buy the right funds, right businesses, and sleep over it.
Right. What's that one advice would you give to investors who are in their 30s?
In their 30s, allocate well. Allocate well to the right asset classes which can give better compounding.
Where do you see Nifty by 2030?
Again, I can't give a number, but let's put this way that your long-term returns from Nifty has been more like 12%. 12% means you double every 6 years. So by 2031,
31 should be.
Typically, you should be
50K hitting 50K.
You should be doubler just by the past compounding rates.
One book that you would recommend to investors?
So you can look at this book, which I really like, is Richer, Wiser, Wealthier by William Green.
Right.
Now this guy is an author. He's interviewed in this book 12 fund managers like Warren Buffett, Charlie Munger, Monish Pabrai, a couple of more, Sir John Templeton, many good fund managers, and he's interviewed their journey of investing. Uh, Very interesting book. You're reading the best guys, interviews of the best fund managers or money
Definitely.
managers. So I think must read book for everybody of any age who have some inclination to understand how money is made.
Right. Brilliant. Thank you for that. One movie that you would recommend to investors to watch around money?
So I like to watch a lot of movie on financial markets, but these are all broadly fictional movies, right?
Right.
So in Hindi, this movie came Scam,
Right, of course.
Amlan Harshad Mehta.
Harshad
I
Mehta's
love that
life.
movie, or maybe Wolf of the Wall Street. That was one movie. There was one more movie of Michael Douglas. I can't remember the name. But these are fictional movies. You can't read much from there.
Yeah.
But yeah, I think a lot of documentaries, I would say, on YouTube, like The Big Shot.
Yeah.
That's very interesting. I mean, I've seen 3-4 times, and I would say that there's one superb thing I learned from Ramdev ji. He referred. It's by Charlie Munger. There's a YouTube video. Do watch it. He says that making the first million is difficult. The second million comes very easy.
Right.
So I then watched that podcast, and it's amazing. So generally, your first million or the first 1 crore is very, very difficult.
Right.
After 1 crore, getting the next crore is and next multiple crores is very, very easy. So it's a long podcast, 60 minutes, but amazing.
Right.
So I've given you multiple
These are really,
multiple
really
options.
good.
Yeah.
These are really, really good.
This is what
recommendations.
I've been doing, and I've actually watched, seen, read. I like them.
What money advice would you give to couples?
I've not been the great guy out here, but yes, I would say that amongst couples, one need to really talk it out, discuss income, expenditure. If both the couples are working, then discuss your earnings, discuss your expenditure, plan your savings long term. I would say that do your will, do your estate, ensure nominees, and all of those things are placed. So it's a very serious subject, and within a couple, this should be discussed, reviewed
Right.
on a regular basis, and if at all any action has to be taken. But be transparent, be open, talk about it.
Right. Brilliant. Thank you. Who should be my next guest that you would love to watch on my show? Any recommendations for me?
So some of the best guys are coming, but honestly, if I have to see somebody outside Motilal Oswal, then I think somebody like Radhakrishna Damani ji.
Okay.
Yeah, I would love to hear him, because he's not a public figure, but he's one of the most successful investor, and many successful investors actually take him as a guru. But I have not heard him too much.
Right.
So
I've been trying very hard to get hold of him.
it's a tough thing,
and
but
it's a tough thing, I think. But hopefully, if I get a chance, definitely I'll invite him and
but
have that
within
chat.
our company, you should try to get some time from our group managing director Naveen Agarwal.
Definitely.
Again,
Okay.
he comes very less on
Social media.
on social media and all, but if you get his time,
Definitely,
he
I'll
makes
reach out.
some very solid points.
Brilliant. That's it from my side, Akhilji.
Thank
You
you.
so much for your time. It was really power packed.
Thank you so
And
much.
I picked up so many new things. So again, thank you so much.
Thank you for the opportunity.
Thank you.
Mutual fund investments are subject to market risks. Please read all scheme related documents carefully.